extremely excited to present our valuation for the Georgia State Business Valuation Competition and want to thank everyone involved for this tremendous opportunity. My name is Sam Zalstra and I'm a senior here studying finance and accounting.
My name is Caleb Smith and I'm a senior here studying accounting and finance.
My name is Caden Cool and I am also a senior studying finance and accounting.
My name is Nolan Carroll. I am also a senior studying finance and accounting.
Today we will be acting as appraisers from Dordt University's Defender Capital Management Club to value 51% ownership interest in the subject company. The effective valuation date is March 1st, 2024, and it was prepared October 17th, 2025. This report provides our team's valuation of the fair market value of the subject company on a controlling and marketable basis. This valuation has been prepared to fulfill all valuation standards.
The subject company is a family-owned corporation based in Texas founded in the late 1970s that serves industrial clients across the oil and gas and industrial sectors through 2 retail stores, a mobile service vehicle, and an online platform where they sell fire-rated apparel and PPE. Through their in-home embroidery and localized fulfillment, they are able to deliver a consistent product that enhances their valuation. Our company has 175 employees and a management structure that balances strategic direction and day-to-day execution. The CEO provides overall leadership supported by the president, who drives operations and key initiatives. Some of these include payroll restructuring to boost retention, customer service expansion, and workflow automation to scale without additional overhead. Sales have climbed from $49 million in 2022 to $58 million in 2023, a 19% increase year over year, driven by repeat business from core industrial clients in the oil and gas sector. Their top 10 customers now account for about 37% of revenue, highlighting both loyalty and some concentration risk, as this is a higher percentage than the industry.
Within the competitive landscape and market positioning as a whole, the first 2 things to understand is the generally fragmented market, along with the fact that the things that really drive growth are quality, reliability, and customer service. These are competitive advantages that our company excels in by keeping 1 month of stock, along with having a strong brand reputation. I mean, you're not around for 40 years in the Texas-based area with continued revenue growth without having a strong foothold. And so overall, the industry is quite competitive, but our company is relatively stable within it, thus reinforcing a low to moderate risk industry profile. The PP&E market as a whole is expected to grow by about 4.6%. Now, from an industry perspective, the key things to understand are that a lot of this is based on OSHA regulations. So within the PP&E market as a whole, oil and gas companies need these PP&E equipments. They need the gloves, they need the hats, they need the jackets to continue business operations. And so based on these industry tailwinds, along with our company's general resistance, because we've had strong revenue growth for 40 years, even in times of economic uncertainty, that reinforces an overall low to moderate risk industry premium. Turning to the macroeconomic side of things, the federal funds rate is expected to come down to about 2.3 points, as can be seen here from the Federal Open Market Committee's federal funds dot plot chart. And overall, what will that do for the PP&E industry? It's expected to expand CapEx business expenditures going forward, and this will generally turn to a raise in demand for our company's products. When we're looking at macroeconomic trends, it was important for us to look at our company's regional indicators and look at the confidence that the middle market has to inform our overall assessment of industry and company risk. Now turning to that economic outlook within the Texas 11th District region, which is where our company is situated. So actually the regional outlook is pretty solid looking at the beige book. In fact, it's expected to expand going forward. And this is informed by decreasing cost of capital, reinforcing increasing CapEx numbers. Overall, business sentiment has been resilient within our company's region, which is really solid to see. We can expect CapEx to increase going forward, which will create an overall cautiously optimistic growth rate for our company, and it creates a moderate to low risk for the industry as a whole. As can be seen, the non-financial sector credit to GDP ratio has been decreasing over time, but as business confidence improves due to decreasing cost of capital, we can expect that to increase. The key takeaway is that if rates decline and spending increases, for the purpose of our valuation, this supports higher growth and a lower discount rate, which will uplift our value. However, there's also limited downside due to stable cash flows, even in times of economic uncertainty, due to regulatory issues and the fact that PP&E stuff is just required for businesses to continue to operate. Overall, based not only on the industry and overall economic outlook, it is expected that PP&E industry as a whole has a moderate to low risk profile, given current macroeconomic conditions. Within that industry, and the macroeconomy, our company is situated as being on the lower side of risk due to its situation within the middle market and both solid inventory efficiency and consistent customers. As recalled from our company overview, customers have been with us through the ups and downs of the market, which is awesome to see. And for purposes of our valuation, this informs our decision to give our company a low to moderate risk profile within this already lower end risk industry.
These are the financials provided by management. They are a great starting point and a great guide for reasonable projections for the analyst prepared normalized financials to come.
This slide outlines the key income statement adjustments made to normalize earnings for valuation. The most significant were the PPP loan forgiveness amounts in 2020 and 2021, totaling about $3.6 million, which we removed as one-time government subsidies. We also adjusted for COVID-related payroll credits, including the $1.6 million employee retention credit and the FFCRA credit, since these temporarily reduced expenses and don't reflect normal operations. In 2023, we removed management profit-sharing payouts and charitable contributions, and note that charitable donations were taken out across all years, as they're voluntary and non-operating. These adjustments follow ASA BVS 2 guidance and ensure the income statement represents sustainable, recurring earnings used consistently in both the market approach and the DCF analysis. This is the company's normalized income statement after adjustments. The expense structure used from 24 to 28 here aligns with management's forecast, giving us reason to believe they expect it to remain consistent going forward, especially since it largely excludes the COVID-impacted years. This normalization provides a clearer picture of ongoing operations and sustainable earnings. We'll discuss the specific forecasting assumptions and how they drive our valuation when we present the DCF section.
We applied all three ASA approaches as of March 1st, 2024. The income approach used the DCF model to capture intrinsic value based off future cash flows. The market approach applied the guideline transaction method, analyzing comparable private company deals. The asset approach used the adjusted net asset value as a reasonableness check. These methods produced a controlling marketable value, to which we applied a modest DLOM for illiquidity, arriving at a controllable, non-marketable value, then multiplied by 51% to determine the subject interest.
We began our income approach by selecting the discounted cash flow method, which best captures the company's intrinsic value based on its projected cash flows. We chose DCF over the capitalization method because the company is still experiencing changes in growth and reinvestment, making a multi-year forecast more appropriate than a single stabilized period. We valued the business as of March 1st, 2024 using free cash flow to invested cash flow over the normalized 2024 to 2028 fiscal year forecast periods, discounting each forecasted year back to the valuation date. We began our DCF by normalizing EBIT by removing non-recurring items and aligning adjustments with those in our market and income approaches. Projections were built with management input, assuming sales growth of 8% through 2025 and 5% through 2028, reflecting post-COVID recovery and stated plans. Expense ratios used 2022 to 2023 averages to represent stabilized operations. Overall, these assumptions align with 5-year historical averages, excluding 2020 to 2021, to reflect a sustainable long-term outlook. In our forecast, we applied a 22.9% blended effective tax rate. The federal rate is 21%, and because the company operates in Texas, it's also subject to a 0.375% franchise tax on gross profit. We modified this interaction directly, treating the Texas tax as deductible at the federal level, producing a consistent 22.9% combined rate. Applying this formula each year gives us a stable, defensible assumption that reflects how the company's taxes would actually be incurred. Depreciation spiked in 2020 to 2021 as CapEx paused during the pandemic while assets kept depreciating. To normalize, we excluded those years and based our assumption on the 2022 to 2023 average, where depreciation was about 57% of CapEx. We then applied that 57% ratio to our normalized CapEx projection to maintain consistency with long-term asset replacement. This approach keeps depreciation aligned with sustainable reinvestment levels rather than short-term spending swings. To forecast CapEx, we separated maintenance from growth spending to reflect true reinvestment needs. Maintenance CapEx averaged about 0.25% of revenue from 2019 to 2023, covering routine replacements like embroidery machines, vehicles, and facility updates. We reviewed individual capital accounts under $15,000 to confirm that these were ongoing maintenance items. Growth CapEx includes 2 initiatives. $280,000 for new embroidery machines in 2024, and a $1.2 million website rebuild spread over 2024 to 2026. Both provide long-term benefits and are capitalized. After 2026, we normalize CapEx at roughly 0.9% of revenue, aligning with the 5-year average and reflecting a sustainable reinvestment rate for post-COVID volatility. This chart compares our normalized average CapEx to the analyst's detailed projections. We based depreciation on the normalized forecast to maintain consistency with long-term, sustainable operations rather than short-term project spikes. The 2024 increase reflects a website revamp and equipment upgrades, but once their website is operational in 2027, CapEx returns to the 5-year historical average, aligning with management's view of stable post-COVID reinvestment needs. Instead of a formal cash flow statement, we assess cash efficiency through the company's cash conversion cycle. We forecasted receivables, inventory, and payables using DSO, DIO, and DPO to capture how earnings turn into cash. Other accounts like prepaids and payables were modeled as a percent of revenues using 2022 to 2023 averages. This provides a clear view of liquidity, reinvestment efficiency, and free cash flow impact. For accounts receivable, we began with 2023 DSO and reduced it by 1 day per year through 2028, reflecting gradual efficiency gains from new workflow software, so receivables grow slightly slower than sales. Inventory DIO also declines by 1 day annually, capturing improved purchasing and production control, freeing up cash. For payables, we increased DPO by about half a day per year, reflecting stronger supplier terms. Collectively, these shifts shorten the cash conversion cycle and enhance free cash flow generation.
For discounted cash flow model, we calculated a WACC of roughly 14.3%, with all inputs as of March 1, 2024. Because the company operates with minimal debt, we applied the industry average capital structure of 27% debt and 73% equity, based on BVR's cost of capital data for retail specialty firms. Our cost of equity was developed using the build-up method, which incorporates the risk-free rate, equity risk premium, size premium, and a company-specific risk premium to capture private company and industry-specific risks. The cost of debt was derived from the current credit conditions and adjusted using our blended tax rate of 22.9%. Together, these inputs reflect a realistic capital mix and risk profile appropriate for valuing the company's invested capital. To estimate our implied credit rating, we benchmarked the company's financial ratios against rated peers, Cintas, UniFirst, and Vestas. Our interest coverage is 318x versus Cintas' 17x, with debt to EBITDA of only 0.04x and cash to debt of 11.6x. These metrics show exceptional liquidity and minimal leverage, supporting a strong investment-grade profile consistent with an A+ rating. This chart shows our company on the S&P rating ladder beside Cintas. Based on strong coverage, low leverage, and high liquidity, we'd score near AAA on Damodaran's synthetic scale. To stay conservative, we start with a AA+ and apply a 3-notch private company adjustment, concluding with an implied rating of an A+, consistent with strong investment-grade quality. We estimated our cost of debt using the A+ credit rating from our earlier analysis. On March 1, 2024, the risk-free rate was 4.46%, and Damodaran's data showed an A+ default spread of 0.92%, giving a before-tax cost of debt of 5.38%. That aligns closely with Moody's AAA yield of 5.01%, confirming that our slightly higher rate for an A+ borrower is both reasonable and well-supported. We used the build-up method to estimate our cost of equity since the company is private and lacks a reliable beta, making CAPM less appropriate. The risk-free rate comes from the 20-year U.S. Treasury yield via BVR, consistent with the long-term valuation horizon. Our 6.45 equity risk premium, also from BVR, reflects a historical spread between the S&P 500 returns and the 20-year Treasuries. We added a 5.18% size premium from BVR's cost of capital data for smaller firms under about $550 million in value, appropriate for our company's $60 million revenue relative to peers like Cintas and Vestas. We excluded an industry premium and instead deferred it to our company-specific risk calculation. Together, these inputs result in a cost of equity of 18.1% used in our WACC as of March 1, 2024. We applied a 2% company-specific risk premium to capture unique risks beyond market and size factors. The main driver was customer concentration, about 1.5%, given reliance on oil, gas, and utility clients. We added another 0.5% for management depth and energy cyclicality, partly offset by diversification and strong financials. Overall, our 2% aligns with BVR data for mid-market firms facing moderate concentration risk. We used a 3.5% terminal growth rate, slightly below the 3.9% long-term U.S. nominal GDP forecast. It reflects 2.2% inflation and 1.7% real GDP growth, consistent with a conservative view for moderate risk firms. Our cross-check using a 23% reinvestment rate and an ROIC about 1% above WACC supports a sustainable growth rate near 3.6%, confirming that 3.5% is both reasonable and supportable. Our DCF uses a 5-year projection period, aligned with management's view that it reflects a market participants' expectations. Extending further would add unnecessary uncertainty. We apply a 3.5% long-term growth rate beginning in year 5, feeding into the terminal value. The discount rate is 14.3%, producing a 10.8% capitalization rate. Using an end-of-year convention with stub periods, the first cash flow, about 0.83 years from the valuation date, is properly discounted. Each projected cash flow and the terminal value under the Gordon growth model are discounted back to March 1, 2024. Together, they indicate an enterprise value of $27.6 million. Adding cash and subtracting interest-bearing debt from the most recent balance sheet gives a concluded equity value of $29.5 million. We ran a sensitivity analysis to test how changes in our long-term growth and discount rates affect value. Since a portion of the WACC is derived from qualitative risk premiums, we varied it by plus or minus 1%, and growth by 0.5%. Our base case, $29.5 million at 14.3% WACC and 3.5% growth, rose to about $30.53 million when growth increased to 4%, nearing our market approach value. However, 3.5% remains the most reasonable and supportable long-term rate for this company.
Overall, for the market approach, we ended up going with the precedent transaction method because it better captured market behavior on a control level pricing. We're valuing this company for a potential sale, and it being a private company meant that looking at prior M&A activity will actually be extremely helpful in establishing a transactional basis. When turning to our criteria, we looked at BVR and deal stats, specifically at companies greater than about $800,000 in revenue and with a positive trailing EBITDA margin, just to make sure that, our company, being a positive, profitable company, aligns with the transactions we're looking at. And these are those aforementioned said transactions. You can see here a lot of different companies that really align with what we do with these specific uniforms. That's what we're really looking for as a guideline feature. And so you can see the transaction methods. Now the thing we're really going to look for here is the MVIC price, the transaction amount, corresponding to the EBITDA, profit, sales, and SDE numbers. Now we turn to those multiples. So we look at the overall MVIC corresponding to what those actual sales were, which can be seen here. Now we turn to those actual multiples. So what we did is we consolidated them into looking at overall these multiples. Generally, the peer multiples showed a tight range, confirming stable comparables. And with the fact that our company is low to moderate risk relative to the market, we felt like selecting the median would actually not be the best way of looking at it. Generally, we felt like our company's risk profile and consistent cash flows and reliable company. You can see those exact multiples applied here. For assets and net debt, we also made sure that the MVIC price we reported is consistent with the transactions we used. To do this, we used the purchase price allocation in deal stats to adjust the MVIC for other ancillary assets and liabilities, just to make sure that the assets we are using are being allocated into the MVIC price and those are consistent amongst all comparable transactions, thus creating a reasonable final multiple that can be applied with the same standards to our company's valuation. Overall, EBITDA reflects the company's best recurring operating performance, independent of capital structures, taxes, and accounting choices. And that's why you say go with 60% here as the primary indicator. And this also aligns with control level pricing metrics found in deal stats. We still did want to weight gross profit as an operational efficiency indicator, as this captures company's general pricing power and cost of goods control, and our company is really solid on its profitability margins. Additionally, SDE, we felt like this is just reflecting of total ownership available cash flow. Our company being a larger company means there's a smaller weighting here, but it's still good to observe private transactions of a comparable scale, as this is something that's going to help unweight those smaller transactions. And net sales was simply weighted at 10% due to a cross-check on scale and growth. So the overall sales multiple provide a useful benchmark to verify reasonableness, and you can see here our overall conclusions of value based on the market approach.
We use the asset-based approach to establish a control level floor value consistent with ASA standard BVS 3. Although the company isn't capital intensive, it holds substantial tangible working capital, mainly receivables and inventory, supporting a minimum equity value under a fair market control premise. We applied the adjusted net asset value method, which best captures the fair value of assets and liabilities on a going concern basis. Fixed assets were adjusted to fair market value using internal records, and we confirmed no off-balance sheet or contingent liabilities. All adjustments were developed as of March 1, 2024, assuming continued use of existing assets and operations. Starting with the February 29, 2024 balance sheet, we reviewed each item for accuracy and market relevance, applying fair value adjustments supported by management input and industry benchmarks. Moving into our balance sheet adjustments, we refined each account to reflect fair market conditions as of the valuation date. For accounts receivable, we saw clean collections, but the company historically carried a 3% reserve for doubtful accounts. We reinstated that to remain consistent with the market practice and prior performance. Inventory turnover is 5.5 versus 6.5 industry average, about 10 extra days of stock. With no obsolete items and steady demand, we applied a 5% markdown for minor aging to bring it to fair market value. Prepaid taxes and deferred tax assets were removed as they stem from non-transferable historical elections and provide no realizable value to a buyer. PP&E saw a 50% adjustment supported by rising replacement costs and a fixed asset turnover of 34.6 versus 18.5 industry average, indicating above average efficiency. Notes payable had an implied 7% borrowing rate versus 5.4 market rate. We increased the liability by 15% from $180,000 to $208,000 to align with market debt costs. Aside from a 2023 cyber incident with no financial impact, no material off-balance sheet exposures were found. Collectively, these adjustments align the company's assets and liabilities to fair market value, providing a consistent foundation for our income and market approaches. The resulting adjusted net asset value is about $14.3 million, providing a credible floor value for our overall analysis. However, given that this NAV is far below our market and DCF results, and considering the company's consistent revenue growth and strong positive EBITDA margins, it stands to reason that liquidation for parts is highly unlikely as of the valuation date or in the foreseeable future. So this method does not drive our overall conclusion of value. To determine our discount for lack of marketability, we use the Stout DLOM calculator, which relies on restricted stock and private placement studies. This tool provides a data-driven, market-based benchmark consistent with ASA-supported empirical approaches and is widely recognized as an industry standard. Based on our key inputs, 8.8% restricted stock equivalent discount, 14.1% private entity adjustment, and a neutral market volatility factor, the model produces a base DLOM of 21.7%, representing a minority non-marketable interest. Because our valuation reflects a controlling 51% ownership interest, we reduce that base DLOM by 40%, consistent with Stout, Mercer Capital, and ASA guidance, since a controlling holder can create liquidity through dividends, recapitalization, or sale. This adjustment results in a final applied DLOM of 13%, which appropriately reflects both empirical data and the enhanced liquidity of control. In addition to the quantitative model, we also considered qualitative factors outlined in the Mendelbaum versus Commissioner. Together, these quantitative and qualitative considerations reinforce that our DLOM appropriately captures the real-world illiquidity investors face when selling shares in a private company, and its application directly reduces our concluded equity value under both the income and market approach.
After taking a look at the DLOM, we now come to our final conclusion. So we got our three numbers for the NAV method, the precedent transaction method, and the DCF. Now we ended up going with a weighting of 75% for the DCF, 25% for the transaction method, and we didn't even weight the NAV at all. And we talked about this a bit earlier, but the asset approach really is not meaningful for a profitable going concern company. They have a lot of profit, especially going forward, and we expect that to continue. So selling it for parts really isn't viable. But for the market approach and income approach, look, the market approach is a great secondary cross-check. However, It does have limited comparable data. It's still got some great matches for our valuation purposes. Is look, we are valued for a potential sale. So looking at previous M&A transactions had a lot of value, but the DCF is overall our best approach because it's most tailored to our company's actual operations and it's based on the company's actual risk profile, which we had taken into account earlier in the presentation. After using all three valuation methods, Dordt University has valued at a 51% interest of our subject company on a controlling non-marketable basis $13,759,478.24. Thank you.